Open your banking app right now. Go to your savings account and look at your most recent transaction history. Scroll past the subscriptions and the groceries until you find it. That tiny deposit at the end of the month. It usually says something like interest credit. And next to it, a number so small it's almost a joke. 0.02, 0.01. 2 cents? That 2-cent deposit is a slap in the face. It is the bank's way of saying thank you for letting us use your $50,000 to make billions while we give you back enough to buy exactly 1/3 of a stick of gum. You think your bank is a vault where your money is safe. You think they are providing you a service, but the truth is much darker. To a big bank, you aren't a customer. You are a source of cheap liquid capital. They are taking your hard-earned savings, lending it out to other people at 7 or 8% interest, and giving you back 0.01%. They are pocketing the difference and calling it profit, while you lose 3 to 5% of your purchasing power every single year to inflation. I call this the bank account lazy tax. It is the price you pay for inertia. It is the fine you pay for being too busy to move your digital ones and zeros to a place that actually respects your labor. Today, I am going to show you exactly how the big banks are fleecing you. I'm going to show you the math of how playing it safe is actually the riskiest move you can make. And I'm going to give you the step-by-step framework to fire your big bank and give yourself a 5% raise by sunset tonight. I'm Mark Fletcher. This is the Money Sprint. Let's look at the ledger. How does a bank actually make money? Most people think they make money on fees. And while fees are a multi-billion-dollar secondary income stream, the real money is in the spread. When you deposit $1,000 into a Big Four bank, you know the names, the ones with the massive towers in every city. They don't put that cash in a box with your name on it. The second that money hits your account, the bank deploys it. They lend it to your neighbor for a mortgage at 6%. They lend it to a small business owner at 9%. They put it into government bonds at 4%. The bank is a middleman. They borrow money from you, the depositor, and they lend it to others. But here's the kicker. In any other business, if I borrowed something from you to make a profit, I'd have to pay you a fair rental rate. Right now, the fair rental rate for cash, the risk-free rate set by the Federal Reserve, is over 5%. But your big bank is still paying you 0.01%. Why? Because they can. Because they know you're too tired from your 9 to 5 to look at your statements. Because they've spent hundreds of millions of dollars on marketing to make you believe that convenience is worth thousands of dollars in lost interest. They are betting on your laziness. They are banking on your inertia. Every day your money sits in a traditional savings account, you are effectively handing the bank a gift-wrapped check for the difference between what they are making and what they are giving you. Your bank doesn't hate you because you're a bad person. They hate you in the sense that they want you to stay exactly where you are, uninformed and stagnant. The moment you become financially literate, you become expensive to them. And they don't like expensive customers. Let's look at the actual cost. I want you to see the numbers because 0.01% is a boring number that doesn't sound like a threat. Let's say you've been responsible. You've saved $50,000. That is your emergency fund, your house down payment, or your sleep at night money. In a traditional big bank savings account at 0.01%, that $50,000 will earn you exactly $5 in interest for the entire year. $5. You can't even buy a decent burrito for $5. Now, let's take that same $50,000 and move it to a high-yield savings account, or an HYSA. Currently, these accounts are paying around 5%. In 1 year, that same $50,000 earns you $2,500. That is a difference of $2,495. Think about that. For the effort of spending 10 minutes opening an online account and clicking transfer, you are choosing between $5 and $2,500. If I told you that there was $2,500 sitting in a bag on a sidewalk 3 miles away, you would run there. You would skip lunch to get it. You would fight through traffic. But because that $2,500 is being slowly bled away in the form of unearned interest, you let it slide. This is the psychology of the lazy tax. We don't feel the loss of money we never saw, but it is just as real as if the bank reached into your wallet and took 20 $100 bills every single year. Over 10 years, if you keep that $50,000 in the big bank, you have $5.50. In the high-yield account, assuming rates stay steady, you have over $81,000. That $31,000 difference is a car. It's a college tuition. It's a year of retirement, and you are throwing it away because you think the bank with the branch on every corner is safer. This brings us to the biggest lie the big banks tell you. We are safer because we are bigger. This is the safety illusion. You see the granite pillars, the marble floors, and the 100-year-old name on the sign, and you think your money is more real there. Here is the reality check. If a bank is FDIC insured, your money is backed by the full faith and credit of the United States government. Period. The FDIC, the Federal Deposit Insurance Corporation, protects your deposits up to $250,000 per person, per institution. It does not matter if the bank has 10,000 branches or 0 branches. It does not matter if the bank is a household name or an online-only bank you've never heard of. If they have that FDIC seal, your $50,000 is exactly as safe in an online bank as it is in the biggest vault on Wall Street. If the online bank fails, the government pays you. If the too big to fail bank fails, the government pays you. The risk is identical. The only thing that changes is how much of the profit they share with you. Big banks have massive overhead. They have to pay for those marble floors. They have to pay for tens of thousands of employees. They have to pay for the naming rights to football stadiums. Online-only banks don't have that. They have a few servers in a warehouse and a lean customer support team. Because their costs are lower, they can afford to give that 5% interest back to you. When you stay with a big bank for safety, you aren't actually buying safety. You are buying the bank's advertising budget. You are paying for the CEO's private jet. You are paying for the brick-and-mortar locations that you probably haven't even stepped inside of in the last 2 years. Stop paying for their buildings. Start paying yourself. But it gets worse. Not only is the bank refusing to pay you for your money, they are often charging you for the privilege of holding it. I want you to look at your statement for a monthly maintenance fee. It's usually $12 or $15. If you have a $5,000 balance and you are being charged $12 a month, your interest rate isn't 0. It's negative. You are paying $144 a year to let the bank use your money to make their own profits. This is what I call financial malpractice. In any other industry, if a service provider took your product, sold it for a profit, and then charged you a storage fee, you'd sue them. In banking, we call it convenience. Then there are the overdraft fees. Big banks rake in billions with a B every year by charging $35 to people who accidentally spent $3 more than they had. They don't stop the transaction. They don't send you a text warning you. They let the transaction go through so they can hit you with a fee that is 1,000% of the transaction value. The big bank model is built on low balance friction. They want you to have just enough money that they can use it, but not enough that you have any leverage. High-yield savings accounts and modern online banks almost never have these fees. Why? Because they aren't trying to nickel and dime you. Their business model is simple. They want your deposits so they can participate in the lending market, and they are willing to treat you like a partner rather than a victim to get them. If your bank is charging you a fee to keep your money there, you are in a toxic relationship. And the first step to wealth is realizing you have the power to leave. Okay, so how do you fire your bank? Most people don't do it because they are afraid of the headache. They think about their direct deposits, their auto pays, and their linked accounts. And they decide it's too much work. The banks know this. They call it stickiness. They try to hook as many of your bills as possible to your account so that leaving feels like a root canal. But I'm going to give you the Money Sprint Bank Switch framework. It takes about 30 minutes of total work, spread over 2 weeks, and it is worth thousands of dollars. Step 1. Open the new account today. Do not close your old account yet. Go to a reputable online bank like Ally, Wealthfront, Marcus, or SoFi. Choose one that is FDIC insured and has a rate above 4.5%. Open it with $100. This takes 5 minutes. Step 2. Link the accounts. Connect your big bank to your new online bank. This is usually done through a system called Plaid. It takes 2 days for the link to verify. Step 3. Move the excess cash. Calculate your operating capital. This is the money you need for next month's rent and groceries, plus a small buffer. Leave that in the big bank checking account. Everything else, your emergency fund, your savings, transfer it to the new high-yield account immediately. Step 4. The direct deposit pivot. Go to your payroll portal at work. Change your direct deposit so that a portion hits the new account. If you want to keep it simple, keep your checking at the big bank for now, but send your savings portion directly to the HYSA so you never even see it. Step 5. The slow fade. Over the next 30 days, look at your auto pays. As each bill comes out of your old account, log in to that utility or credit card and update the payment method to the new account. Step 6. The kill shot. Once a full month has passed and no surprise bills have hit your old account, move the remaining balance and call the big bank to close the account. Do not let them talk you into staying. They will offer you a special rate that is still lower than the online bank. Ignore it. Close the account. You just gave yourself a massive annual raise. You just stopped the bleeding. Now that you've stopped the lazy tax on your cash, we need to talk about the next level of the money sprint. A high-yield savings account is for your emergency fund. It is for money you might need in the next 1 to 3 years. It is shield money. But even 5% isn't enough to build real wealth. Why? Because after you pay taxes on that interest, and after you account for the actual cost of living increases, you are mostly just breaking even. Real wealth comes from stored money. This is the money you put into assets that outpace the economy. Once you have your 3 to 6 month emergency fund sitting in your 5% high-yield account, every dollar you earn after that should not go into a bank account at all. It should go into the market. It should go into low-cost index funds. Banks want you to keep as much cash as possible in their system because it's their lifeblood. They will tell you that the stock market is risky while they take your cash and invest it in the stock market. Think about the irony. The bank tells you to be safe and keep your cash with them, then they take that cash and buy the very stocks they told you were risky, keeping the 7% return for themselves and giving you the change. Cut out the middleman. Once your shield is built, buy the sword. Put your money into the total stock market. Over the last 50 years, the S&P 500 has returned an average of about 10%. That is double what a high-yield account pays and 1,000 times what a big bank pays. The lazy tax isn't just about the interest you're losing today. It's about the opportunity cost of not being an owner of the economy. When you keep too much cash in a bank, you are a lender to the bank. When you buy index funds, you are an owner of the companies. Owners always get paid more than lenders. I want to address one final thing: the fear of the unknown. Some of you watching this have had the same bank account since you were 16 years old. Your parents helped you open it. You know the tellers. You feel a sense of loyalty. I need you to understand something. That bank does not feel loyalty to you. If you fall behind on your credit card payment by 1 day, they will charge you $30. If you try to get a mortgage, they will charge you the highest market rate they can get away with. If they could automate your job and fire you tomorrow to save 5 cents a share, they would do it without a second thought. A bank is a math machine. It is not your friend. It is not your family. The feeling of security you get from seeing that big logo on the corner is a manufactured psychological product. It's designed to keep you from moving your capital. True security doesn't come from a logo. True security comes from a high net worth. True security comes from having your money in an account that actually grows. Don't let a feeling cost you $2,000 a year. Don't let nostalgia keep you in a negative sum game. The money sprint is about efficiency. It's about removing every ounce of drag from your financial life. And a big bank savings account is the ultimate drag. It is a parachute deployed while you are trying to win a race. Cut the cord. We are reaching the end of this video. But this is where your work begins. I've shown you that the big banks are banking on your inertia. I've shown you that the difference between lazy and optimized is thousands of dollars a year. Now, I'm giving you a challenge. I call it the 24-hour bank breakup. In the next 24 hours, I want you to do one thing. Open a high-yield savings account. You don't even have to move all your money yet. Just open it. Put $100 in it. Break the seal of inertia. Once you see how easy the interface is, once you see that first monthly interest deposit that is actually larger than a nickel, the stickiness of your old bank will vanish. You have worked too hard for your money to let a multi-billion-dollar corporation keep the profits of your labor. If you are tired of being treated like a source of cheap capital, hit the like button and subscribe. We are building a community of people who refuse to pay the lazy tax. Your bank doesn't want you to watch this, but you just did. Now go take your money back.